Hi, it's Tim Quast for Market Structure Edge, and I'm going to give this overview on finding winning stocks in any market. And it's been challenging, particularly if your market is cryptocurrencies. I'm in the data business because I grew up in the agricultural market, which reminds me of a story. So there were these two ranchers talking to each other, and one says to the other, "Hal, I hear that you inherited some money." And Hal says, "Yeah, it was a surprise. My aunt willed me some money." And they were quiet for a moment, and then Bill says, "Well, what do you plan to do with it?" And Hal's quiet for a moment, and then he says, "Well, I figured just keep ranching till it's all gone." And we don't want you trading till it's all gone. We want to find ways to take gains, not chances. And that's what Market Structure Edge is all about. So you can follow along in this presentation. Just click that free trial button there and add your name and email. And when we get to the part of the presentation where we visit the platform, you'll be able to track right along with us. And on that request a demo button immediately to the right here, whenever you're listening to this, I'm doing a live demo on Thursday, June 16, but I do them regularly, and you'll see where they are. I handle those myself. They're live and interactive, and we talk a lot about entries and exits. Easy way to learn how to see supply and demand, which is the core of the Edge platform. And why would we have anything to say about this? This is the, why the hell listen to this slide. I've spent over 20 years on market structure, the behavior of money behind price and volume in context of rules. And we say that Edge is the new way to trade because it's predicated on that idea and nothing else is. And it's a brand new platform from the standpoint that it's only been around for 2 years. And for the first 18 months of that, hardly at all. We were, aiming small, missing small, and perfecting it. But it comes from a very good pedigree. I started a firm in 2005 called Modern IR. That's the largest provider of market structure data to public companies who use the data to navigate the market and to understand what the money's doing. The stock market is a grocery store. It has demographics, and we're experts nationally recognized as such. 2017, I was asked to provide written testimony to Congress to recommend ways that we can improve the market for investors and issuers. It just reflects the fact that we have a known reputation for expertise in market form and function. That's the background to the platform. And market structure, which is the core of Edge, is the behavior of money behind price and volume in context of rules. There's a physics of the stock market. That's what market structure is, and we can make that part of our decision-making process so that we have a much higher probability of navigating the market successfully. And here is how market structure has changed over the long time that I have been in the profession. If you go back to 1995 when I started in the investor relations profession, that's the liaison between public companies and investors, and we provide, Modern IR provides data to that function. That if you look at it from a volume standpoint, most of the volume in the market came from active stock picking. That is, the driver is corporate fundamentals, earnings multiples, expanding top line growth, improving margins, improving bottom line, which would follow. Most of the assets under management, over 90% of them then, were actively managed. There was only one ETF in 1995 and smatterings of other things. So all you had to do to find winning stocks is buy the ones the best stock pickers bought. Right? That's the way to go about it. Today, the stock pickers are 10% of trading volume. They're the smallest demographic in the market. So in a sense, the ones the best stock pickers buy have a 1 in 10 chance of winning because it's the smallest part of volume. All these other purposes and time horizons, prices, characteristics, derivatives, are 90% of volume. This is why you cannot depend on earnings multiples. Oh, the S&P 500 is trading at 15 times earnings. That's a good entry point. Well, that's true if you're the 10%, but it has no bearing on what those other behaviors do. Prices are relative, and so you have to realize that going in. And why is this true? Well, it's because market structure makes winning harder. All of the rules under what is called Reg NMS, that's Regulation National Market System, that's what that means, direct prices toward the place between the best bid to buy and offer to sell. That's the law. Well, what resides there? Average prices could be time-weighted, a TWAP, volume-weighted, VWAP, pegged, floating, but the average prevails. Stock pickers want outliers, things that are above average, whereas passive money wants things that are the average. And so when the rules advantage people who want the average price, well, then average is going to outperform superior, so to speak. Ron Barron of the Barron Funds, classic legendary bottom-up stock picker, said in a CNBC interview that he's owned 2,500 stocks over the years since 1983 when he started that firm. And if he takes 15 of them out, he's average. Well, that's less than 1% of stocks. So can you find the less than 1% that will make you superior? Or are you just going to track the 99% that make you average? Well, that's what the money does, and that's why indexes and ETFs have won. Then only a handful of brokers execute most of the trades. Out of the 4,100 brokers that FINRA regulates, only about 9 of them execute 90% of customer orders from you and me and from institutional investors. Well, all of that feeds into tracking the mean because those brokers execute things between the best bid to buy and offer to sell, and that becomes average everywhere. So you have to know that. You might say, well, then why would I trade? I might as well just buy and hold. We'll be better off that way. Well, the market doesn't deliver the results that you think. You know, if you started buying the market in 2007 and were putting money heavily in, really trying to ramp up because you wanted to retire in 2009, the Dow Jones Industrial Average was down 54%. Between 2000 and 2002. Suppose you started investing in NASDAQ stocks in 2000, down 77% in 2 years. We don't know what will happen in 2022. The point is, sure, buy and hold is great if you have a static point in time, but we don't. It all depends on when and at what prices you enter the market and when you need the money that you hope will be generated. So realize that. If you look at the returns in the blue chips, the industrial 30, it's just 8% a year the past 22 years. The NASDAQ, our growth market, is worse. You know, I've got buy and hold investments in equities and bonds, but I can't count on it because of this. I mean, this is 8% and 6% before taxes and inflation. And so this is why we want to find ways that will produce superior returns. How do we find winning stocks? Well, there's a very simple notion that market structure edge advances, and it's the basic economic principle of any market. Again, the stock market is a market with consumers whose demographics can be measured, and there is demand created by those consumers and supply created both by the market and the consumers. And the balance of those things determines outcomes. If there is a bias toward demand, then prices rise. More demand than supply, prices go up. More supply than demand, prices go down. Pretty basic economic principle. And that's what we want to focus on with Edge. There are 3 rules to keep in mind when using Edge. That's the core one, but preceding it is this. Beware broad sentiment. What is the whole market doing? And why is this true? Because of market structure, forcing group behavior, uniform movement toward averages. The stock market is the Titanic. I'm not saying that it's destined to sink, but that it will carry you with it. You can fall in love with a certain stock or group of stocks, but if there are deck chairs on the Titanic, no matter how lovely they are, they're going to go down with the ship. And so you have to beware that that condition exists. The good news is the condition of the market, its supply-demand balance is measurable. Second, beware of context. I'm recording this on June 15th. VIX expirations occurred today. Volatility as an asset class recalibrated. Did that blunt to some degree the response to the Fed's Interest rate hike, 75 basis points. Well, quite probably so. It's an input that says we will have volatility to contend with, which can cause people to buy assets, but it's not a reflection of investment sentiment. And all this week there are expirations. Thursday the 16th there are expirations. The 17th is a quad witch. Russell rebalances are continuing. S&P quarterly rebalances are occurring. Leaps expire. There's a holiday Monday. New options trade. The next, whatever that date is, the 20th or 21st. I think it's Tuesday the 21st. The banks will square their books. That stuff is going on. It will distort the outcomes that you expect from things, as do earnings, as do month ends. So you have to be aware of what is occurring in the broad market. And then with that backdrop, you can focus on trading diverging supply and demand, where if you're going long, you want demand to be rising and supply to be falling, or a divergence of some form to exist so that you have a better probability of higher prices. Doesn't matter what prices are. Doesn't matter what the multiple is. What matters is, if you buy it now, is there a probability that when you want to sell it tomorrow or whatever day it is, it will be higher? Well, that's all we're trying to do. If you go short, if you short stocks, then you want the reverse. You want falling demand and rising supply so that whatever price you've borrowed it and sold it for, that when you cover it, it's at a lower price. A pretty simple concept. That's the beautiful thing about hedge. Here, it looks like a complicated chart, but there are only three things to know. This is the rule number one, beware broad sentiment. This is how we manage risk. This is price for SPY, and then you have demand aggregated into a 10-point scale. Everybody can understand 1 to 10. The more time that stocks in the market spend above 5, the more there is excess demand, and the more the market has a propensity to rise. The more time it spends below 5. And that's aggregating demand as those demographics, the different purposes and time horizons that drive buying. The more time it spends below 5, the less well the market behaves. And you can see it right here. When the market rises above 6, that red line on a 10-point scale, a lot of stocks, so 500 stocks here is what we're looking at, then there becomes a probability that the market declines because people will stop buying. And then down here's the third part. So price, demand, and supply. The supply chain, every market has a supply chain. The supply chain of the stock market is short volume, not short interest. Short interest is a 1974 measure created by the Federal Reserve to track its monetary policy, to track the use of margin accounts. Short volume is a 2009 measure. That it reflects the amount of trading volume coming from stock that is borrowed or created. Like the Federal Reserve, market makers can create stock to fill orders so they can maintain a continuous auction. They're not choosing to, they're required to by the SEC, which says Goldman Sachs or Citadel, if you need to make a bid or offer of 100 shares, you have to fill it. What if we don't have stock? If we have no buyers or sellers, then you may create stock to fulfill that. Well, that's measurable. So we know that if demand has peaked well over the red line and begins to fall, and the supply side is rising sharply, what will the market do? Will probably decline, particularly until those conditions reverse. Then rule number 2. This is beware of the context. What is the context? Here's June. Look at all that cluttered stuff this week as I record on June 15th. Well, why would you run into the middle of that gunfight and risk being shot? You can avoid those things. You don't have to be in the market all the time. Be in the market when it will benefit you. Avoid it when it won't. That's a very important principle. And then finally, we want to trade diverging supply and demand. Here's Phillips 66. I traded this and made lots of returns in May by doing this. When demand rises and supply falls, buy it. You don't have to be perfect. This is demand, here's price, here's supply. 3 simple things. And when those conditions reverse, when demand wanes, now it's still above 5, energy had a lot of demand, so it's not that it's going to collapse, and supply rises, well, that's a good time to get out. Notice that what followed that was a depression in price. Then you can return. Here's a slightly different condition, but demand stopped falling, and then could return to rising. And supply dropped. Well, that's a divergence. Steady demand, less supply, price rises. When supply increases and we're heading, and broad market sentiment is now topped, and we've got options expirations in a Fed meeting, then it's time to be out. It's not complicated. You don't have to carefully watch price. You don't have to be precise. Just use supply and demand. And then that will have a consequence for price. And if you follow that over and over, it works very well. It enables you to take gains and not chances. So now let's go over to the platform, marketstructureedge.com, and I will show you examples. Okay, continuing now, here is the platform, and this is what you will see when you arrive at Market Structure Edge. Right across the top, here's beware of broad sentiment. And if you click that, you can see that very graph that I showed you. Shorter time frame here, just by a little bit, but here it is, price of SPY, demand from those various forms, various behaviors that drive buying and selling, and supply. And when demand is above the red line and begins to fall and supply is rising, market's going to go down. Here's you want to come into the market here and out there. Just beware, at least. You don't have to do that, but you have a way to understand mounting risks. And we were telling folks using Edge about that. And I didn't hear anybody else expressing concern that the market could drop sharply, but it did. And we could see that coming in the supply-demand imbalance that was developing. Now, at your dashboard, if you're running a trial, you know that there are 15 portfolios. I think I got that number right, 15 or 16, that we put automatically on your dashboard to show you all the sectors, so you can see the 11 GICS sectors of the market and where the money's going, plus what we used to call the FANGs, plus there's a TQ's ideas, there's big and stable, and momentum. And they're the ways to see what the best choices are. And the market will offer opportunity to be in things that ride volatility well. That's what we call big and stable. And then there are things that you can trade when demand is rushing into the market that are likely to do even better than the broad market. That's momentum. And I have all kinds of other things here. You can see airlines and cruise ships. But the telling point across all of these tiles representing different portfolios, you can create them, we'll create them. They can be dynamic using criteria, and we'll give you whatever feed meets those criteria every day, or things where you, in static fashion, put in stocks like I've done with airlines and cruise ships. But they're all typified by demand and supply, those same principles. Not price here, because the price will come from the individual components. But I can see that demand is falling and is below 5 in airlines and cruise ships, and supply has been on a strong 30-day uptrend, even though it's come down some in the last few days. Clearly, it's not the place to be. And you could kind of look across the whole market right now: cannabis, clean energy, cloud computing. If you want to short something, probably communication services offers opportunity because supply has risen sharply above trend and demand is falling. That's what you can see. Now, what I want to show you is big and stable is designed to give us things that do well in volatile markets. And when there are 15 components in there, that tells you that's a good thing to do. And it will give us the kind of stocks where money will take shelter. In volatile markets, the low volatility strategies will stack into things, and we can see that using math. Well, notice, there are none in it. It's telling us there's nothing in there that will ride you through a volatile market because of everything that's going on. That's just math, but math is better than guessing. Hope and luck are not strategies. Math is a strategy. Then let's go look at momentum. Momentum will look for stocks that have very strong demand and weaker supply. And because that's the kind of thing that produces higher prices. Well, there's one component in it. It's being led by passive money, indexes, ETFs, quants. It's in consumer discretion. It's JD, by the way. Chinese stock listed here in the US markets. Maybe it means China stocks have a ways to go. It still offers some momentum, but the fact that there is only one, not 15 or 20, tells us the market is also not a momentum market. You can't rely on good gains. You can't rely on good shelters from volatility. That is a message to stay clear. So then, well, what do we trade? Well, let's look at some examples. Let's suppose that you just love NVIDIA. You want to trade tech stocks. Well, once again, hope and luck are not strategies. If NVIDIA looks like this, and I'll show you, well, it's just not the time to trade it. You want to trade stocks with demand well above 5 and diverging from supply. I mean, there may be a little opportunity in here where you had a little divergence between demand and supply, and sure enough, the price went up a little bit. But that's not sustainable. This is, the only reason NVIDIA is up is because there's been some short covering. Supply has dipped below trend. It's not demand. And so that's not sustainable unless one of those things changes. Well, don't do that. No matter how much you love a particular part of the market, go where the money is. And, I talked about Phillips 66, but let's look at LPI, Laredo Petroleum, a great stock to trade here in the trailing 30 days. And just look at the difference. See that? This is when I bought it. When demand's rising sharply, it's well above 5 and supply begins to fall, I know I'm not going to worry about what the price is. I don't care what the price is because price is relative to supply and demand. And if demand is rising and very strong and there's insufficient supply, price is going to rise. When those conditions reverse and demand remains very strong in LPI even now, but the supply is way above trend, the likelihood that the price continues to rise drops. Well, why don't we go find something else to take gains and go put it in something else that has a good supply-demand equation? That's how you do it, and it doesn't have to take long. Another one, Antero Resources, great stock in the last trailing 30 days. Just giving you some examples of what these things look like. Once again, if you have strong demand, I like it to be above 5, maybe even already at 10 if supply dips. Look at that divot here in supply that gave the stock a nice lift. Once the demand begins to deteriorate and supply is above trend, leave. Just take your gains. That's your entry and your exit. And you don't have to machinate over it. You just look at it once a day and it will tell you. And you don't have to worry about price. That is the way to use the data. I'm going to finish up over here back at our presentation with one thing. This is why Market Structure Edge works. Avoiding declines and keeping gains is superior. Clearly. And you want a mathematical edge to do that, and this does it. Time is risk. You don't have to be in the market all the time. You want to be in the market when it will give you returns. Otherwise, don't be in it. Market structure rules stocks. All stocks, no matter what they're doing or what business the companies are in or how they trade, they're all governed by market structure. It's the great equalizer, and we can use that to our advantage. And trading supply and demand is simple. Supply, demand, don't trade price, trade supply and demand, and you will see the effect on price. And last, beware human nature. You can have a great stretch and you think, I'm just going to do, boy, I've done so well. Yeah, broad sentiment's deteriorating. I'm going to do one more thing. That's when you get into trouble. Trust the math. It's far better than luck and hope. That's how to have an edge.